Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. One of the least popular ideas these days relates to a barbaric relic that nobody seems to like: gold. Initially, the yellow metal benefited from the Fed's massive quantitative easing in the second quarter of 2020. Prices soared to an all-time high of $2,075 in August, but since then the metal has been marching downhill. What's wrong with it? Mention gold to tech investors and they ask why, when there are far more exciting and lucrative ideas out there, like electric vehicles, biotech, or fintech. Young investors think it is something their grandfathers like and are sucked into thrilling situations like GameStop or AMC, where entertaining short squeezes and 500% returns are possible. Value and income investors think gold is doomed, and even long bonds like the US 10-year is now producing some income. Warren Buffett famously dislikes gold and wrote in 2013 that a century from now, the 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. When gold is mentioned to investors who prefer sound money, even they are now looking enviously at the digital version of gold, Bitcoin. Why buy gold when there is Bitcoin? The cryptocurrency has a limited supply, responds to inflation too, and is a far, far more rewarding trade than gold. A decade ago, gold traded at around $1,800 and Bitcoin at just 1 cent. And now, gold still trades at around $1,800 and Bitcoin has rocketed to $60K. The difference in return is stark and absolute. The winner of the Asset of the Decade competition is undoubtedly Bitcoin. So, is gold destined to be consigned to the ash heap of history? Well, no. There are many arguments for investing in the metal. First, gold bugs will argue that Buffett's reasoning is wrong. A century from now, most paper currencies would have lost most of their purchasing power. In 1970, a troy ounce of gold cost $35. Now it costs $1,750. Gold is an asset that holds its value when paper money depreciates, and depreciate it will, because central banks can't stop printing money. Wait until the next recession, and you will probably see another round of Fed quantitative easing. Gold will hold its value during a monetary crisis because it is a safe haven asset. The second point is that gold is well liked throughout the history of mankind. It has, in Peter Bernstein's words, stirred the passions for power and glory, for beauty, for security, and even for immortality. Will this fascination go away? We doubt so. Gold still holds a massive trade around the world. It has $10 trillion in value. Nations are still buying gold when prices depreciate. And not so long ago, gold prices rallied for 10 consecutive years. From 2001 to 2011, gold prices kept going up until it climaxed during the sovereign debt crisis in the summer of 2011. In many ways, gold is an asset that responds to the ebb and flow of speculative capital. It moves in cycles too. At this point, gold is losing in the global beauty contest. Many investment factors are still stacked against it. However, if gold prices keep falling, say 30 to 50% from its August 2020 peak, then value will appear. After all, the answer to low prices is low prices. For example, currently 1 Bitcoin buys about 34 troy ounces of gold. Imagine, just imagine, in a not too distant future, where 1 Bitcoin equals 100 troy ounces of gold. Where do you think value lies? If this happens, it is possible that capital flows will return to some of the more traditional instruments like gold. All in all, investing in gold is a complicated process, but it is not hard. To make money from gold, one needs to be patient because it does not move like Tesla. The cycle in gold is measured in years rather than weeks. This is a problem for many investors because they want the return now. Technically, gold is in a weak spot at this point, both in absolute and relative terms. Prices are falling and the metal is underperforming other asset classes. However, given the hypermonetary stimulus in the background, gold remains a good asset in providing stability in an investment portfolio. Yes, gold prices will not go up 10 times in a year, but neither will it go down 80%. You can even trade gold from time to time when sentiment is at the extreme. Who knows? After an 8-month consolidation, gold could be due for a rebound. Trackstar IQ, our proprietary search tracking tool, shows that the SPDR Gold Trust was the second most searched ETF last week. Maybe it's time to have a deeper look. That's all we have time for today, but please do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.